You probably use Fibonacci retracements in your trading, but do you really understand how they work? They're one of the most popular tools in trading, yet most traders completely misunderstand them. Everyone talks about Fibs, yet I've still not seen a single video which shows you how to apply them the right way. I've been using Fibonacci retracements in my trading for years, and for the last 7 months I've been sharing my trades for free on Discord with an over 85% win rate, and I use Fibs this exact same way. Let's start at the core. What is a Fibonacci? The Fibonacci is a sequence of numbers found all around you in nature, where each number is the sum of the two numbers before. So 0 and 1 is 1, 1 and 1 is 2, 2 and 1 is 3, 2 and 3 is 5, 3 and 5, 8, 5 and 8, 13, 8, 13, 21, and so on. This creates a ratio which is found in galaxies, leaves of plants, branches, lightning, veins, the DNA structure, cell division. You get the point, and that ratio is called the golden ratio, the blueprint of nature's design. But why does it work in trading? Well, the markets are driven by the collective behavior of the participants, and the majority of these participants are algorithms, around 60 to 80%, but probably more. And these algorithms are programmed to react to specific levels, including Fibonacci retracements. There is also the human psychology of the levels, which I'll explain shortly. One thing to keep in mind before we start is that the Fib retracement is a tool to help you find areas of support and resistance where price may potentially retrace to and continue in the overall direction of the trend. And you don't use this tool alone. You use it on top of your analysis to put the odds in your favor and help you identify the better potential setup. Most people either plot them wrong or follow them blindly without the context, and that context is very important. I'm going to show you exactly how I plot the Fib step by step, what the different level means and how to use them, and share some powerful tricks that I've learned over the years to make the most out of it. First, you need to identify two key points, the swing low and the swing high. These points represent the start and end of a significant move. If you're in an uptrend, you plot from the swing low to the swing high. If you're in a downtrend, you plot from the swing high to the swing low. So knowing what swing highs and lows to use as reference is something that gets better over time and with experience, but the best thing that I could tell you is plot the most obvious and clearest levels and try avoid small, noisy, insignificant levels. You can also plot fibs from smaller swings for shorter term setups, but do keep in mind that they hold less weight and they're more susceptible to manipulation, and that larger swings are more reliable as they are of interest to a larger portion of the market participants. You can also combine these two fibs, and I'll explain that in the live examples. Once you plot the fib, you'll see these levels. The levels I use are the 38, the 50, and the 61. Some traders use the 78.6. I don't use that one bit. There's also the 23 fib, which I only use for profit taking, and again, I'll show that in the live examples. Not all of these levels are equal. Some are more significant than others depending on the scenario. So the 38 is a momentum trade. If price bounces from the 38 and goes back to the respective swing high or swing low, then technically speaking, you've got momentum, because this is a shallow retracement of the overall move, and it signifies that there's not much resistance to the trend. So the 50% is not part of the Fibonacci sequence, but it still works because of the psychology. It's the halfway point, which is used by algorithms, but also traders to reassess, to cash their positions, or to even potentially enter positions. And finally, you've got the 61, which is the golden ratio. This is kind of like the last line of defense, and if this level is breached, then most likely you are looking at a trend reversal. In my last video, I talked about a concept that if a level is breached, the odds of the backup is increased, and that applies for fibs as well. If the 38 doesn't work, then the odds of the 50 delivering are higher, because if you think about big money, if they did not cash their positions at the 38, they're more likely to act on the next level. And it works the same way as if the 38 does work. Now, I'm not going to say the 50 isn't going to work. If the 50 is breached though, the odds of the 61 are higher, because if they didn't act on 50, they are likely to cash some positions on the 61. So remember to take this with a grain of rice or a grain of salt, whatever they say. 38 works, breach of 50 to take 61. If breach of 38, odds of 50 are higher. Now I'm going to say this again, fibs are not to be used alone. They work best when stacked on top of your analysis. And for me, the foundation to my technical trading is key levels. Fibs are just built on top of that. And that means you plot your levels first and then you plot your fibs. Let's look at this example on GJ on the daily time frame. We're only going to look at potential buy case scenarios. I've already got all the levels plotted out. Now I'm going to plot the fibs. So you first plot the most obvious fib. And a tip that I would give you is when plotting a fib, to check its validity, you see how has it been reacting prior. So if we were to see this fib, let's see how has it been reacting. So after this initial move, the 38 worked, breach of 50 to take the 61, even though the 61 was a slight miss. You extend it, 38 worked with a bit of drawdown. You extend it even more. I'm not going to look at the 23 at the moment. So the 38 worked, 50 worked, 60 breached. So once the 61 is breached, it doesn't completely invalidate the fib. It just means that there's a new swing low, and you use this as reference, but do keep an eye out on this one. It just reduces its appeal. And then with this fib, let's go into the lower time frame. Let's see how has it been reacting. So the 38 worked here again, 38 worked. Let's keep extending it. So this trade, it was yen intervention. That's why it was a sharp move towards the downside, where the 38 was breached and the odds of the 50 are higher, and it did deliver. And then you just keep extending it, and as you can see, the 38 worked again. Now what I'm going to do is I'm going to plot the smaller fib. Now for me, instantly this is where I would plot it from. But if you are struggling with identifying where to plot it from, if you go on to the higher time frame, sometimes it's a lot easier to see where the swing lows and highs are. So price pushed up from here, and then when it came down, this is where it pulled back to before continuing towards the upside. So this is where the smaller fib would go from. And again, you apply the exact same logic. You see how has it been reacting on its way up. So then you plot it from here. As you can see, the 61 worked. You keep extending it. The 38 also worked. The 50 worked, and the 61 worked. So all of these levels did work. Now I'm going to quickly touch up on this example because I took both of these trades. So the first trade was the 50 after a breach of the 38. Now there were other reasons to be in this trade, but in terms of fib, there was a breach of the 38 to increase the appeal on the 50. Now worst case scenario, if the 50 does get breached, you've got the 61 to back it up, and you've also got the big 38. So you've got a double fib as a backup plus a better level. Now one thing that I'd like to say is, just because I said a smaller fib holds less weight and it's more susceptible to manipulation, it doesn't necessarily mean that it will be a weaker trade setup. It all depends on the scenario of how price has come to that level. If it's had big pullbacks, if it's breached other levels, there's so many different variables which affects the odds of a setup. But if you're talking just in terms of fibs, then yes, the smaller fibs do hold less weight. But in the right conditions, again, they can give a much bigger reaction. Now back to this example, the 61 has been done and dusted, so we'll get rid of this fib. It is of no interest to us. So now the only things we've got left is the 50 and the 61, which line up with a key level. A lot of people online will tell you to wait for a rejection, for candlestick closure, for other confluences or reasons that price is going to respect the fib, which yes, it can work, but how I trade is I'll set a pending. I'll only get in when I know the odds of profit taking is high, and that profit taking is when algorithms are cashing their positions at the fib, when even traders who've got take profits or entries, and when that initial exchange does occur, what you'll see is you'll see a bounce on the price, and I cash most of my position at the bounce because that bounce is easier to predict, and then it's a fight between buyers and sellers. Then if there's more buyers, then price will go up. Great, I've got a runner to capitalize on that. And worst case scenario, if it continues to go down, I still make money. I've still made money overall, but I still had the potential to capitalize on the move up. Finally, just a quick touch up on the 23. I only use this mostly for profit taking, but it can also be used to find areas of pullbacks, but they are going to be very aggressive pullbacks. And for that to work, you need to understand the drivers and where the momentum is and what's causing it. But this is an example of the 23 break retest after such a sharp move down. It does make sense, and funnily enough, there's also a fib at the exact same level. So if you want more information on how I use the fib or want to see me using it live in the markets every single week, Join my Discord, the link is in the description. Hopefully this video did help. If there is anything you didn't understand, join my Discord, ask as many questions as you want. It's completely free.